Good morning, good afternoon, good evening, everybody. Thank you so much for joining us in today's 22nd edition of the CVC Insider Series. Today we have a wonderful session prepared with Baris Guzel, partner at BMW iVentures that comes from an incredible background in engineering, as well as a long experience in top-tier investment banking and venture capital firms. But before we get started, I just wanted to quickly set the stage so you all have some context. First of all, my name is Alba, and I'm part of the 500 Startups team. 500 Startups, we are one of the world's most active seed-stage investors with over 2,500 companies invested in 80 different countries around the world. And at 500, we began this journey within the CVC field, believing that there could be great opportunities in bridging and helping raise the bar in corporate venturing, building a strong community of practitioners that share best practices. So every 2 weeks, we host this roundtable that features corporate venturing practitioners to share their own unique journey into corporate venturing, what were some of the challenges that they faced and how did they resolve them, and what were some of their unique learnings that they would like to share with the community. So as a result, we hope that you enjoyed today's session, and our host, Nicolas Sauvage, will be moderating the discussion, but there's also a Q&A section. So feel free to ask questions along the way, and we'll do our best to cover them. So hope you enjoy today's content. And Nicolas, please feel free to take it away.
Thank you, Alba, and thank you for joining from Kenya. So this is really appreciated, and 500 Startup for supporting these really good initiatives. Like Alba said, it's about practitioners that share their learnings and best practices. And today, gosh, we have a good practitioner. I know Baris for a while, and I really enjoy talking to him every single time. So Baris, if you could just spend 5 to 10 minutes to talk about your personal journey into corporate venturing. It didn't start right from corporate venturing, so I think it would be interesting to get your personal journey.
Absolutely. And first of all, thank you so much, Alba and the team for organizing this, as well as Nicolas for inviting me for this. It's a pleasure to be here. Let's start with the background. So actually, originally I'm from Turkey. I studied industrial engineering at Istanbul Tech, which is like MIT of Turkey. Then I was fortunate to be on a full scholarship and then study a master's in engineering and technology management at Duke, as well as a full ride for my MBA in North Carolina. After which I moved to the dark side. I did investment banking at BofA Merrill Lynch in New York on the Wall Street, and then Deutsche Bank's technology investment banking practice, where I worked in a lot of SaaS startups, SaaS companies, M&As and IPO transactions prior to joining a few other institutional VC funds in Silicon Valley. And then I joined BMW iVentures roughly 4.5 years ago. So, and you're right, Nicolas, this is my first corporate job. So there's a lot of learnings happening throughout the path. And also there's a lot to be discussed in terms of investments. And we've been so far in a quite fortunate position.
Very good. So I can already see we're going to cover a lot of questions because you go extremely quick. I think you're the quickest introduction we ever had. I think the 5 to 10 minutes, you made it in 60 seconds. So let's talk about your engineering background. How useful is it for what you do today?
Sure. So as an industrial engineer, actually, my first job experience was on the manufacturing floor, where I was programming CNC machines and also going through all those different manufacturing methodologies, injection molding, die casting, CNC. And fun fact, you probably would not see on my LinkedIn profile, but my first job was working on the manufacturing floor of Daimler's bus plant doing Kaizen studies.
All right.
And fast forward 15, 20 years later, my first investment at BMW iVentures was in the manufacturing space, in a manufacturing marketplace company called Asymmetry. So it's one of those things, as people say, do not think too much about the dots. In the long run, they connect in ways that you would not be able to imagine at the beginning.
That's a good way to say it. My first paid engineering job was in Siemens, so I think we have some connections there. Okay, very good. And what about your financial VC background? I mean, you were an associate in a VC firm. How much of that shaped what you do today? Because some CVCs have people who have never worked for a financial VC. How much of that do you think it helps you?
I think it is especially important given our unique structure. Maybe I can touch on our unique structure at BMW iVentures, what kind of sets us
Yes, please, especially as you call yourself a hybrid venture capital. So I would really like to know more about this.
Yes, absolutely. So BMW I Ventures actually started back in 2011 out of New York with a more traditional corporate venture capital fund structure, essentially. So think about version 1.0, more traditional, small check sizes, internal approval processes. Yet end of 2016 and early 17, BMW senior management decided to set up a new and independent VC fund, because we realized, hey, we actually have to move faster and act bolder in many of those different areas we're looking at. So since then, we are essentially an institutional VC fund with single LP, which is BMW. So the idea is having the best of both worlds, the speed, flexibility, and financial focus of an institutional VC funds, hence my financial background helps, as well as deep domain expertise, as well as ample network of an engineering powerhouse like BMW. So the idea is working very closely with internal colleagues to vet opportunities before probably somebody else in the world can do similarly.
Okay, very nice. And maybe I will ask a question I never asked you, and maybe I should have asked you before. Why is the I in BMW I Ventures? And I ask because also last week, Toyota AI Ventures dropped the AI. Now they're called Toyota Ventures. So why do you have this I?
When our fund was first set up, BMW I was the brand entity. And when you look at BMW I product line, you're going to see mostly futuristic products, especially in the electric vehicle space with i3 and also another breakthrough product, i8. So that was the main rationale behind that branding.
All right, very good. And you talked about speed, and on your website, the first sentence talk about executing quickly. I want you to tell us first, why do you think it matters? But two, how do you make sure you deliver on that promise? If it's the first sentence on your website, you better deliver. So talk us through this execute quickly.
Sure. Given my background on the institutional VC side, Nicolas, I'm happy to let you know that we've got pretty much the same process in place here at BMW I Ventures. As we are fully independent in our decision-making process, it's pretty much like a typical institutional VC fund where you've got partners meeting on Monday mornings, and you move very quickly as we do not need any internal approval. This helps us move as quickly as a traditional VC fund. Why does this matter right now? I don't think there has been ever a time like we are living in right now where there's so much of capital inflow coming straight out to Silicon Valley to make investments in very interesting companies. This means that you have to act much faster than one could imagine, meaning that you cannot just say, hey, come back in 3 to 6 months, because the top opportunities, the great ones, are not going to be out there staying for long. So that's why it's important to be nimble, quick, and make decisions based on the facts in hand, as well as also still trying to tap into existing know-how and domain knowledge that we've got internally. So that is the logic. That's why when we look at our return profile, we've got financial goals in strategic relevant verticals. So the idea is bringing both of the best worlds.
Very nice. When you talk about internal approval, you don't mean internal to BMW I Ventures, but you mean internal with a mothership?
So what I mean is we are a team of 12 at BMW I Ventures. We sit down, assess the deals, make our own decisions, and move forward with the term sheet, just like an institutional VC fund.
Very nice.
At the same time, we take a lot of input from our internal colleagues. We care a lot about what they say, but at the end of the day, it is up to us to make that decision. And again, we are responsible for the results of those decisions.
Very nice. And clearly you mentioned you have financial and strategic goals. On the financial side, what do you think are the best KPIs?
Clearly IRR. So that's what we are using right now. And so far, things are moving pretty nicely right now. When you look at our vintage year, we're in the top quartile performing of all the VC funds in our vintage year.
Very nice. And I think this is interesting because most people talk about funds return first and then they talk about IRR second. I like the fact you went straight to IRR without hesitation, and there's a time element to it. So do you mind explaining the IRR to the audience and why it matters more than the funds return per se?
Sure. So let's say you're looking at an institutional LP for a traditional venture capital fund. These could be large endowments, could be large family offices, or traditional corporate VC model, more corporates. So as a money manager, what you're looking at all the time, you're benchmarking yourself is capital allocation, optimum capital allocation. What does that mean? That means typically you allocate certain parts of the pie into different asset classes. And then what you do is you compare them in terms of a return profile, meaning that if I can make investment in risk-free interest asset class, making 2, 3, 4, 5%, then if I'm a venture capital investor, if I do not beat that, then there are substantial issues because venture capital is known to be one of the highest beta investment classes out there. Yep. So this goes back to the traditional Kpis model. What you do is you look at the volatility and you try to justify the return profile accordingly. So the idea is coming up with the relatively attractive return profile with the relatively higher risk profile of our business, because as you know, most of those startups do not survive.
Yeah, no, I was calculating last week a very simple calculation. A fund for 10 years, 2% management fee. If you want to return a 12% interest rate equivalent, you need to do 3x on the fund. This is really, really hard to do 3x. So the time element really, really matters. I agree. So we talk about the financial KPIs. You mentioned strategic KPIs. How do you define them? How do you measure them?
It's a great question, and this is still an area we keep learning every single day. As just like our mothership, many of those corporations have got different goals over time that shift rapidly, and sometimes some topics are becoming a lot more interesting and relevant. So we typically try to work as closely as possible with our internal colleagues to identify what the key priorities for them are. And also doing, for example, deep dives in those interesting verticals, building some kind of a domain know-how, building some kind of a market understanding, but also at the same time helping those startups connect with our colleagues internally and get their perspective as well. And then over time, when you look at 10, 15, 20 different companies in the same vertical, number one, you build a certain understanding of the market dynamics. Number two, you got one of the most interesting customer who are essentially my colleagues and amazing engineers internally that BMW has got. So all of a sudden, you get a unique perspective on some markets, some players, and it helps you build some kind of conviction in this entire process. And hopefully you find an interesting investment target accordingly.
And do you have some level of alignment of goals between the people you interact in BMW that maybe you need help with and your own KPIs?
So we are in constant contact, especially with BMW technology office. So we are based out of actually BMW's Mountain View technology office, which helps us a lot as many of our colleagues are out there looking for new cutting edge technologies that could be relevant for BMW. So there's that kind of a symbiotic relationship with our colleagues. We sit with them literally right next to each other, which helps also facilitate those serendipitous conversations, to be frank. At the same time, you've got also regular conversations with our senior colleagues in Munich, and we've got many of those alignment conversations we're having internally.
I remember visiting your office just off 101, and this co-location was, I think, really special because it also allows you to tap onto very high competency about the technology you're doing due diligence. Do you think that's the best practice for other CVCs or hybrid VCs to leverage? Because at the end, like you said, there's a lot of capital. Differentiation really matters. And you being able to tap on this level of competency for due diligence, but also for helping afterwards really matters. So any best practices about this co-location or now that we were mostly remote, maybe co-location was different, and how did you make it happen?
Yeah, I think it's probably one of our secret superpowers, to be frank, because fundamentally, when you look at all those VC funds on Sand Hill Road, they all have different perspectives, yet probably none of them has got as deep of a domain expertise or know-how we can tap into. We've got some of the best engineers internally who are looking at these topics day and night. So it's going to be very hard for somebody else to match that kind of domain know-how. For example, most recently, we made an investment in a company called Solid Power. Again, our unique benefit, our unique advantage in this equation of us working closely with our battery colleagues who have been looking at the space for so many years, looking at so many companies, and also I did a deep dive in the battery tech space. I probably talked to more than 200 companies in the space. So I think I'm a much better investor because of my colleagues, engineering colleagues, and I hope my engineering colleagues are feeling the same way. They're better engineers because I help them see some other companies that may not be aware of. And we always exchange thoughts and perspectives all the time. So there's that kind of a mutually beneficial, great relationship in between.
So I will disagree. It's not your secret superpower. It's not secret. So I think what I like about your model and what you're doing, Baris, is you're leveraging the best of a financial VC and being nimble and fast while having the superpower of the mothership and the corporate and the deep insight into a space, and you leverage the two. Now, this is not always easy to do. It's actually extremely hard to do. Can you share some of the things that has improved since you joined BMW Ventures, where other CVCs should be like, oh gosh, I have to do the same?
Absolutely. So I think the independence in the decision-making process is crucial, because as a VC, you don't want to be in a position where you make an investment based on some data or assumptions you're relying on, which you don't have first-hand experience. That's exactly the reason we are set up in such an independent entity. So we do all of those exchanges, but at the end of the day, it's up to us to make that decision, up to us to take that essentially call and making an investment. And when we make that investment, we are the ones responsible. It's not going to be our colleagues. I cannot say, okay, he or she said this is going to be relevant. No, there's a reason that we've got such a objective structure, transparent structure in place. This means that sometimes we're going to get a lot of the interesting leads from our internal colleagues. We look at those, but again, we put our investor lenses. We say, okay, this looks like a very interesting company in this interesting market, but here are the hurdles we are seeing for this business to scale. And similar, when we bring those interesting companies, and our colleagues are going to look at those from their own perspective. So, which gives both parties a lot of independence in our decision-making process, but also accountability. Because if my investments go wrong, it's me making that decision. I cannot say that person or this person thought it was relevant. That's why, as this famous saying goes, with a lot of power comes a lot of responsibility. So it's crucial for us to keep ourselves accountable all the time for those topics. Because as you know, sometimes corporates could move from one topic to another, and things can change rapidly. And also, I think there's this different angle from a time horizon perspective, because you and I, if we are investors, we look for potential next 5 to 10 years. So typically, when you looked at the internal colleagues and their perspective, they might be looking at the existing product lifecycle, which might be shorter than your time horizon. And you might be looking at something maybe potentially quite disruptive that nobody else could think of right now. For example, in a traditional setting, I bet if somebody came with Uber or Lyft, then they probably would have said, hey, they're not in the car making business. Why would that matter? But guess what? Over time, if they're able to create such a powerful businesses, all of those become relevant and interesting. That's why when we look at those opportunities, it's crucial to have that kind of financial upside potential to make them strategic relevant down the road, to be frank.
Yesterday, I had a meeting with Sean Carolan, who invested early in Uber. And one of the things he shared, which was really insightful, is that he had these metrics about growth and lifetime revenue and all that graphed into a graph. And even though Uber was still early and it was still the limousines, he could show this was growing like no other thing that he had proposed to his VC before. And what I like about all our discussions is you have deep opinions, informed opinions about what matters and what does not matter. And we all have also our biases. And I think one of your bias, I think you may know, I hope you know, but maybe not, is you like to look at things at scale. You want to see how big it's scale. My own is unit economics. I like to understand unit economics and the roadmap for them. But you always talk about scale, and this is always one of the things that comes to you. Tell me more about why scale matters when it's so early. Maybe it's still about proving the technology, for example.
Absolutely. There are two components of that. So number one is very early on, I think investing is more of an art than science. This means that I don't think anybody has got a very good understanding what's going to happen in 10 years. Maybe Uber's angel investors have done a terrific job, but I bet for every Uber, they've got 150 they are marking off. So that is the first angle. So which means that it's so much of closer to art, it's very hard to justify how big this business could become. And yes, in the hindsight, everybody can say, yeah, he was a phenomenal entrepreneur. I saw this coming. Well, I'll be a bit more skeptical. It's much easier to justify those investments once this company becomes a huge success story than not. That is one component. So for me to be able to feel comfortable to bet on this interesting opportunity, which means also saying no to 100 other opportunities that are in competing space, because when we make investments, it's like marriage. We're going to be essentially working with that company for a long period of time. So we have to make sure that this business could scale rapidly. We're in the business of jet fuel business, to be frank. Can this explode is the first question we ask. At that early side, it's more of a science project than an actual business most of the times. And that in itself makes it very, very hard to build conviction. Second component, for us to create strategic value, these companies need to be at a certain scale. Because if you're that early in your value chain, if you're that early in your company's life cycle, then it's going to be very hard to create value for BMW as well. Because, car companies have got very famous high thresholds for performance. It is a curse because it's not easy to reach, but it's also a blessing because over a certain threshold, then you're in a space where the sales are extremely sticky and massive. So that is the dilemma all of those companies are going through. Otherwise, the easiest thing, I think, for any investor saying yes to early stage investment, very early maybe in the seed stage, this company came out of YC or X, Y, and Z invested. But the reality is, if your goal is building a sustainable business over time, where you're betting your money and your career on, you have to be a bit more diligent. And I think this goes back to the data, because the way I think about this space is very similar to back in the day. Edward Deming said, he was like, without data, you're just somebody else with an opinion. To me, without data, you're just another VC with an investment thesis. It doesn't matter much.
Okay. Now I can see you're passionate about investment. This is your longest answer so far. So this is really cool. Do you have a sweet spot in terms of stage of the company? The stage you really like to invest more than if it's too late or too early? Do you have a sweet spot for you?
Yeah, and just to be clear, we are stage agnostic at BMW.
I'm talking about Baris, actually, in this case.
Yes. So I worked in investments in Series A, B, and C. So C probably for me may not be the best opportunity given all the reasons we have highlighted.
Yeah.
That is number one. And number two is also it is important to have a bit more data sets in hand where we can be a bit more comfortable as discussed. So for me, I think the most exciting opportunities are the ones that are leveraging the cutting edge technologies in more archaic and large industries. So yeah. I do believe that it's crucial to have essentially a technology in hand that increases efficiency and effectiveness. Again, this goes back to my industrial engineering background. So, and when we look at those opportunities, for me specifically, those are predominantly on the SaaS/marketplace business model, and also lately a bit more on the clean tech side, obviously with this battery investment, given also the fact that I worked for one of the largest clean tech investors back in the past. So the idea is, how do you change the economics of the transaction? So typically when you look at those marketplaces, I can also give you some examples from our portfolio.
Yes,
for example, when you look at Uber and Airbnb, what they did was creating millions of new drivers and hotels. Similarly, from our portfolio, we invested in companies such as Zoom and Zometry. So what Zoom did was creating a new pool of school bus substitutes. Yep. Zometry created a new machine shop supply by flipping the local machine shop dynamics to first a national, then a global marketplace model, which essentially helps you to shift the fundamentals of the transaction equation, where you move either the supply or the demand side and making them meet at a price point that probably nobody else can meet. So that in itself helps you obviously expand the market. And obviously, when you look at most of those companies, what they're doing is they're creating a new kind of a supply that helps, but over time, you need to build much more on top of it. So every single step, you hopefully are going to have an easier time to acquire new suppliers and new customers and create a network effect, which over time is going to turn into a phenomenal business, which is going to be very hard to catch for somebody else. Because otherwise, guess what? There is no shortage of capital. There's no shortage of competition. The question is, what is differentiated and what can scale rapidly?
Very nice. One thing you said is you need to invest out of 100 in one. And I think this ratio is probably true for any investments you make, which is you're probably going to say no 99 times out of 100. And I'm actually interested about how you say no to entrepreneurs. And then we will go into the when you say yes and the check size and so on. So how do you deal with saying no to entrepreneurs, which is basically 99% of the time?
It's a phenomenal question. There was I think somebody wrote recently a job of a VC saying no 99 times and then begging for that one time out of 100 to be part of that equation.
That's a good one.
What I care a lot about is being upfront and honest. Because listen, I'm going to be basing my own judgment based on what I know and hear. But one thing that I'm not in the business of trying to just take more of your time and make you do things that are not relevant. So I think that's also very important to say a quick no if I don't have that kind of conviction and be upfront with them. And obviously, if this is just a one-time meeting, you can just say quickly no. But if you're going through a due diligence process, it's important to walk the entrepreneur through why you're saying no and why this could be relevant. I don't want to name the names, but this happened literally this week again. So there was a company we were looking at going through due diligence, and then over time, you've realized, hey, given all those topics we are digging deeper into, we weren't able to build the conviction where we could lead the round or participate in the round. And then we said, okay, thank you so much for everything, but we ended up deciding that this may not be the right risk-return profile. Happy to walk you through our logic. And then the entrepreneur picked me up on that, and I walked him through the logic, what we did, what are the topics we had a chance to dig deeper into, what kind of parties we've interacted with, what kind of analysis we have built, and what are the numbers we got. And that's why we ended up passing because we didn't have as much data in hand. And then he thanked me and he said, hey, you know what, then this might be a better fit maybe next round. So I would love to keep in touch. So that's the kind of interaction we are having typically, Nicolas, because this is a very small ecosystem.
Yep.
So it's important to manage the expectations accordingly. And also entrepreneurs do not necessarily have a lot of time. That's why it's important to be upfront, to be as quick. And also in the same time, I always happy to help them to build internal relations with BMW. Try to ping our colleagues as we are more than happy to pass along interesting companies to our internal colleagues so that BMW could potentially be a customer. Again, as I'm independent, they're independent as well. That helps essentially that transparency and objectivity in the process.
It really helps actually. And because you're upfront about this independence, it also helps clarify when you introduce to BMW, it's independent from an investment decision. I really like the way you've described it because it's about adding value even when you say no. When you say no and you explain why and your assumptions and what you wish to see improved, it's actually adding value to the entrepreneur. If the entrepreneur wants to actually act on it or not, this is their choice, but at least you're giving them a lot of value.
But again, these are subjective topics, right? Maybe we are missing it, Nicolas. So I think it's a big part of the equation also knowing that nobody knows everything.
Yep.
So obviously, whenever I give that kind of feedback, I'm like, take it with a grain of salt. That's kind of my perspective. This may or may not be the reality. Maybe I am missing out something, and I'm happy to fix if I'm missing out something, maybe next round. But here is what we're observing right now.
Yeah, I think the challenge, and maybe why some VCs don't do that, is some have been burned by passing, and then the company becomes a big success, and then you see the screenshot where they passed, and so the guidance I give to my team is assume that your email will be seen on TechCrunch, but make sure that this is actually a very nice, valuable piece of feedback. And so we have this structure which is about what we liked less, or what we wish to see. And just this way of framing helps to tell the entrepreneur where they should actually double down and continue because this is right, and the one where maybe that's not a good fit for us and for certain reasons. And that gives a chance for them to adapt or not. Very nice. I want to talk about when you say yes. And I want to understand, especially you're leading quite a few times. You don't always lead, but you lead a lot, and sometimes you co-lead. And the check size also matters in these discussions, as well as the valuation. But before we touch about valuation, although I'm sure it's also a parameter, how do you decide on the check size? And I'm talking about between two companies that you're in the same stage and probably the same valuation. What would drive you to make a bigger check than the other one?
So I think the fundamental questions are more around the company and how big they could be. And obviously, we also got some targets we would like to hit. If you're leading the round, obviously that has to be substantial for us, right? Because we are a small team and we've got 50 plus investments already in our portfolio. We got to make sure that when we're going to have enough of time for working with that company, we've got enough of skin in the game, to be frank.
Yep.
So when we come on board, we take board seats, just like a traditional institutional VC fund. And we enjoy working with all the other seemingly competitor car makers. We do not view as competition, we work very closely with them. Actually, we help make introductions to many of those other car makers too, to be frank, because we're all friends and in the same ecosystem. Going back to your question around how do I say yes and how do I build conviction, I think this goes back to maybe some thought process behind how do we create outsized return as investors, right?
Yeah.
Nicolas, like how can you outperform the market? Could be S&P 500, could be other VCs, and potentially hit that whatever 5-10x return profile you would like to have. Depends on the stage, obviously. You guys are coming in earlier, so you may want to aim for much higher returns. And again, depends on the check size. And you always ask the question, can this company return the fund one way or another? So I think it probably boils down to three things. Number one is the information asymmetry component, meaning that you probably have got some more data about that company than somebody else. Meaning that if you are Sequoia, you probably get to see 10 companies in the same space. One of them has got 10x growth rate of the others. You probably are going to make investment that was an easy decision. So for that to work, we try to establish much earlier relationship with those companies early on and see how they progress over time. So I reach out often to companies they just recede or much earlier, to be frank, sometimes. There's a case for in our portfolio, for example, there was one company, I really liked the team, I really liked their business model. So it has to make both sense, meaning that the story has to make sense, but also the numbers need to match the story. So the numbers were not there, but I really like the story, the team's approach, how diligent they were when it comes to their business model to create a value in everybody involved in the ecosystem. Fast forward, we kept in touch a year or two after that. Obviously, I helped him introduce to parties within BMW, with other car makers similarly. And then seeing that they reached an escape velocity, and they hit the product market fit, they reached 10x year over year growth, we essentially ended up preempting their Series B round. And we did not need anybody else. We were like, okay, this is a phenomenal business, team is really impressive, the market is massive, there's potential value here, especially winner takes all dynamics in the market. And we are fortunate to have led their Series B round. So that's one example.
But you took the full round or you led the round?
We led the round, but we put in a big chunk of the round to take substantial ownership in the company. Okay. That is one example. The second example is probably more around, so first one is information asymmetry. Second one is probably more insight asymmetry, meaning that you and I look at the same company, you and I look at the same data, but we both end up having different conclusions.
Yep.
And I do believe that this is probably the most underrated part of skill set of any venture capitalist out there. Everybody talks about sourcing, but I don't think there is a decent understanding of deep data analysis and understanding of cohorts in most of the players out there. So there was one case, I don't want to name the names, but we all looked at the same company. This company has talked to all of those big funds. And once we started digging into data, and once I called probably like 20 plus potential customers and hearing amazing reviews, amazing feedback for a business model like theirs, we built a conviction and we led the round. And actually, this was a substantially priced round. But I think in our business, you better invest in an amazing company, in a great company at an okay price versus invest in an okay company at a great price. We are not in the latter business. The latter is more private equity. So that was a decision that we made accordingly. A lot of people looked at it, and we were the ones digging much deeper into data, building those cohorts and seeing how this business could scale, even if they stop spending sales and marketing today, and how big this could be. That was another example. And the third one is probably, this is going to happen over time. I'm not saying that we are there yet. It's going to take substantial amount of time for the track record and reputation over time. Then the third one is probably you can win deals by your reputation. Obviously, This is more relevant for people who have been in the space for 15, 20 years, right? Who are like known for making that X, Y, and Z investments that went public. They are luminaries in their vertical. They know what is happening in those verticals, and you as a startup can benefit immensely from that specific person's experience and network.
Although sometimes this expertise comes with bias. And I think that's where you can add value, is that sometimes you can see a future they don't see.
Absolutely. That's why, again, this goes back to my comments about data. What differentiates you, in my opinion, we are all objective, right? It's important to have data to back that kind of an argument, to say X or Y or Z is going to happen. And there's going to be also that blindness of having too much of information always. That's also something to watch out for. You're right.
So you've shared a lot of golden nuggets. But one thing you've said, which actually is not mentioned a lot by corporate VCs, but a lot by financial VCs, is a potential for an investment to return the fund. And maybe first, let me naive or challenging. Why would you ever invest in a company if it doesn't have the potential to return the fund?
Let me be specific. There are going to be cases where you could see maybe potentially massive different values. Could be potential partnership or strategic value where you can make those smaller check size investments as well. That's also what we do, just to be clear. But I think it is very important to bet on the companies that could potentially shape the future of industries. Yeah. Otherwise, here's my main issue in general, especially given the fact that where we sit in the value chain. When you look at your typical consumer devices, you're looking at a 9 to 12 months of design cycle for your iPhone, for example. When you look at the enterprise products, you're looking at 12 to 18 months of design cycle. You're like your laptop. But when you're looking at your car, you're looking at 4+ years of design cycle, sometimes 7 years. So if the company is not going to be financially successful and grow fast, that company may not necessarily be around to attract enough of capital from other players out there in the market. Company could raise money from strategics. That's great. But for a company to survive in the long run, you need to have those sustainable, increasing free cash flow so that this company could tap into capital markets.
Exactly.
So I think golden rule is looking at what this company could look like and then looking at the capital markets, how they're being evaluated in terms of public capital markets. So I think you need to have that mindset of beginning with the end in mind to see where this could go. It's not like if we can 2x, that's fine. It's okay. Because as a venture capital fund, we've got financial goals.
Yep.
And we still have those companies to establish internal relationships. And BMW has got a group called Startup Garage, which is helping put together pilots with internal parties.
I think at the beginning, you mentioned your financial and strategic mission. But at the end, if you go at the core of your mission is to pick the winners. And if you're good at picking the winners that will shape industries, you will get both no matter what.
Absolutely. That's clearly the case. There was one example. I shouldn't name the names, but literally I wrote, there's not much of strategic value potential from this company, but financial value is incredible. And then over time, that company became so successful. I get a lot of internal things from my colleagues. And all of a sudden, guess what? There are a lot of potential strategic partnerships. Everybody wants to be a part of a success story. It's not the other way around.
Very nice. And here it's a good lead into a question from the audience, Gokul Mohan, because part of what you mentioned is a strategic, sometimes tactical, maybe a smaller check. The question is, how often does BMW experiment with investment portfolio startups?
What do you mean by experiment? Like helping them work with BMW?
Like the initial word he was using was pilot. So maybe engaging and experimenting with your portfolio companies.
We always do that. Obviously, we've got a colleague actually out of Munich office. We've got a business development director who is helping us get the company in front of right parties in Munich. Because as you can imagine, it's a large organization. It's important to spend enough of time to make sure that that company gets enough of attention. So
and is that a full-time role of BMW iVentures or a full-time role of BMW?
It's a full-time role of BMW I Ventures because we think it's important to understand the company's business dynamics so that you could help them internally with the right parties, the right partnership.
Is that a person that's the job title is director of platform, or is that someone else?
That's right. Mm-hmm.
So tell me why you call it director of platforms, because that doesn't ring as business development to me or startup liaison when we use TDK Ventures job title.
Yeah, we think it's important for our colleague to be involved in all of these investment decision discussions. And that way, I think she sees what the potential of this company could be and what we are thinking in the long run, how this company could be beneficial. The title, so my colleague is helping with business development, with strategy, with a bunch of other topics. And also she's also interacting a lot with our internal colleagues closely and gets us also some of those key learnings. She's distilling all of those key learnings so that when we look at opportunities, we know what the key topics are. So it's just beyond business development, but obviously its platform is the name we're using internally.
Very nice. And I also see something interesting and funny on your website. And we just had our marketing principal joining 2 weeks ago, TDK Ventures. So he comes with interesting questions, which I didn't think about it for a long time. But corporate VCs, financial VCs, they tend to actually list everyone on the team section. And in your website, you even include your 3 dogs. So tell me about what you think about having everyone in the team listing on the website, and why do you think that is?
So we've got a very flat hierarchy here. Just to be clear, if you would like to take a look at what the future potential disruptive technologies are, look at what your kids are busy with. So it's important to have that kind of a mindset that in an organization where everybody with any title could contribute a lot and we can learn from is crucial. To be frank, if you don't have that kind of a mindset, innovation may not be the topic you should spend too much time. If you're that much of tied up to hierarchy, title X, Y, and Z, probably venture capital is not the space for you to be in, because we're in the business of backing the underdogs, the ones that are small, the ones that are ignored, the ones that essentially have the potential to outmaneuver the larger incumbents. So because of that, when we do our internal assessment and even in our voting process, we start voting with our interns. We say, what do you think about this opportunity? What do you like? What do you not like? This also helps us also have this kind of a learning loop, because nobody has got all the answers in hand. If you think you got all the answers in hand, I don't think this is the right business for you. You should have always that kind of a humble feeling to learn about those the up and coming new emerging verticals. Like even when you look at what Mark Andreessen says, is that he says that we let entrepreneurs train us. So that is crucial, because back in the day when Mark was building Mosaic, it was a totally different topic than right now. We're looking at the world where machine learning is running the show. So whatever deep domain expertise or skill set you're going to bring to the table is going to be down the road maybe not as relevant. So it's important to have that curiosity, burning curiosity and juice flowing all the time, in my perspective. And that also means you can learn from anybody.
I think you're touching on what I am most scared about right now. Right now, we have tailwinds. The market is going up, the flow of capital, the valuation increase. We all look good. And what I'm scared about is that it will give us a wrong or unjustified sense of confidence. That will make us extremely poor investors and poor partners with the entrepreneurs. Can you talk about how you see the tailwinds today, but also how do you make sure that you keep this sense of, I need to make sure I get all the data and I don't assume too much?
I think this is a key topic. Again, this goes back to being diligent in the process. So what we're observing right now is it's a very serious concern, Nicolas. We also have this internally. We are seeing this huge capital inflow from anywhere in the world flowing into Silicon Valley, trying to take a piece of Silicon Valley. So you see a lot of investors with huge chunks of cash, with limited domain expertise, trying to get into spaces. This also goes back to maybe traditional VC funds, which do not necessarily know as much about what mobility is and how it functions and how the go-to-market works. That in itself creates an environment where every single company gets financed. So I was having this conversation with a pre-seed/seed investor GP, which I respect a lot. He was mentioning that he has made 30 plus investments so far, and none of them went bankrupt. So I do believe that a certain amount of creative destruction is healthy for any system to be sustainable. So that's a key topic. So how do we avoid that? So it's important not to rely on proxy due diligence, as Bill Gurley says, because there's so much of fear of FOMO.
Yep.
There are so many entrepreneurs you get to meet on Thursday, you got to put together a term sheet on Monday, or I'm going to be gone, kind of a mindset, which creates a kind of a different decision-making process, because fundamentally success is a lagging indicator. I do think the proxy for success is your process, how diligent you are. Because guess what? Today, this company does A round, B round in 3 months, maybe 4 months, C round. But if this company could not create as much of value down the road, guess what's going to happen when the music stops? You can mark it up. We can easily mark it up. Momentum investing is the easiest thing, right? You look at X, Y, or Z famous VCs backing this company, let's put the money in, somebody else is going to come and back you up. It's exactly the stuff we take a step back and do not try to participate in.
I can't agree more. I think that following the process is so important. And this sense of confidence, what I worry about is that then people make shortcuts in the process because they feel like maybe they are better and better. I'm going to pick on something you just said, which is when the music stops. And you were one of the first to write really good insights on SPAC on Medium. I remember the article. And the analogy I'm giving to my team today, and it's probably exaggerated quite a bit, but I'm saying that today it feels like 100 people dancing around 200 chairs for SPACs. And I worry the day where you have 200 people dancing around 5 chairs. So can you, and I know you have some of your portfolio going through SPAC, same for us. By the way, congratulations on Zoom going for an IPO with an S1 filing.
Asymmetry, yes, Asymmetry. Yes.
Yeah. So really,
Thank
congrats. You. But can you talk about what you think about the SPAC and how it's influencing how you even decide to invest in some companies? Because now SPACs becomes a real opportunity for some companies which are less consumer-friendly messaging, but very technical with very good business. Now it becomes a really good option for them to go public, which probably means your decisions to invest is shifting. So can you talk about how you see SPACs and how it's changing the way you invest?
A great question. So first of all, SPAC on itself, you're right. I started writing back probably more than a year ago about this topic, as this is fascinating, right? I'm coming from capital markets, M&As and IPOs. So this is just another financial product, another financial innovation. This is just another toolkit for any company to look at as an opportunity. Yet, at the same time, this is not the right toolkit for every single company out there, right? Because the moment you go for the SPAC route, there are some certain issues and there are some certain opportunities. Opportunities, you go much faster than a traditional IPO historically, and you got some unique advantages in being able to do promotion maybe much better than an IPO, because if you're going through a traditional IPO process, you're not allowed to project your future financing, right? You cannot say, hey, we're going to go through this kind of a hockey stick growth story. So promotion is quite limited. And then there's also gun jumping rules and a bunch of legal requirements you need to go through in a traditional IPO process. So that was a gray zone a little bit historically, and we've seen also lately SEC coming up and speaking about these topics, especially safe harbor law. Let's see what they're going to end up deciding for. But in itself, this also created a lot of opportunity for companies that have substantial business or business potential with massive revenue signed, and that might be a bit more capital intensive than your usual companies. And that helps those companies to go public much faster. So the way I think about a SPAC is a growth round plus IPO in a compressed manner. Because when you look at the statistics, typical IPO is roughly 12 to 13% of the company's combined value in terms of the cash being raised. Whereas when you look at the SPACs and the pipes, you're looking at SPAC and a pipe combination becoming a dilution of roughly 35% of the new combined entity, which means you can raise much higher amount of cash. But obviously, just like everything else, there's also downside, meaning that this means more dilution. So if the company does not need as much cash, if the company is already profitable, if it's already growing very, very fast, probably you're going to go with something like direct listing. I'm a bit bigger fan than a traditional IPO. Having worked in a traditional IPO process as an investment banker, I know it's an exciting process, but there could also be some downsides given the fact that everything is getting priced in the last night, depending on the circumstance in the capital markets, among other things. But fundamentally, I do believe if a company is doing great, regardless of what product they end up picking, direct listing, IPO, or SPAC, they're going to be doing phenomenally down the road.
Very nice. So I really like the way you frame it, which is it's a growth round plus going public. I really like this. And it's a good insight. Now, one of the things I want to touch on is the SPAC goes with a pipe. And what I'm starting to understand more and more is what really matters is the quality and the size of the pipe, because at the end of the day, only the pipe is guaranteed money. The SPAC, some of the investors could decide at the end they remove the money.
Redemption, yes.
Exactly. So can you talk about the importance of understanding the pipe? Because I think that's not talked enough, and this is actually really an important element for entrepreneurs to understand.
So in a traditional IPO setting, Nicolas, when you go out and raise capital in the IPO, you talk to more established Fidelities, T. Rowe Prices of the world, who come in and buy your shares and indicate this to the market. Hey guys, this is a pretty solid company. We are professional investors. We do this every single day and we buy shares from this company. Pipes play a similar role because when you see those companies, again, this is the same batch of investors typically. When BlackRocks of the world, when you got Fidelities of the world to come in and buy your pipe shares, this shows the markets, hey, this is a substantial business and we allow buying this business at this price. But this also anchors the investment because typically those kind of deals are tied up to a certain pool of cash being soft circled. If the redemption goes too high, then the transaction could collapse. But the more pipe you have in hand, the clearer it is.
Yep.
And for any SPAC, you need to have a certain threshold of voting, proxy voting, essentially deciding for yes for the transaction. So that essentially limits that downside. But at the same time, it also means more dilution.
Yep.
That's why it's also an art to deal with that process. And what we are seeing lately is that there's a lot of pipe investors coming in and sometimes pushing SPAC investors for going a lower valuation because sometimes SPAC investors might go with a higher valuation that pipe investors would be happy for. So they're breaking down, they are essentially pushing back 20, 30% pricing cuts. So these are all happening. And as we speak, I think market is also self-selecting. That's the beauty of the capital markets, right? They're essentially over time, they're just going to be self-correcting. It may not be perfect in the short run. Yes, there's been that crazy bubbles, many interesting companies going public, maybe too early. And going back to your question, as more and more companies are going earlier in their value chain, the returns are going to be looking more like venture capital, if you ask me.
Yeah.
Meaning that you're going to have small number of companies that are going to do phenomenally well. Yet you're going to have a chunk of companies where they may not necessarily do as well, and they might struggle. And we're already seeing this happening in the capital markets. Just look at the headlines, what's happening. So it goes back to the topic that we discussed earlier. It's all about the quality of the company, the quality of the offering and the management team, and also hopefully with large, substantial contracts being signed up, showing that kind of hockey stick growth.
Yeah, no, it makes a lot of sense. And I think you could probably argue if the pipe wants to renegotiate the valuation, that's probably a very strong signal the entrepreneur needs to listen to.
Yeah, I mean, that's the power of free markets, right? The capital markets. So that is happening. We're also seeing lately, actually, there was one company that went public with a SPAC without any pipe. So I can see that also happening, but we are seeing more and more, these are called unique investors participating in the pipes, meaning that could be existing investors in the company or SPAC shareholder sponsors that are coming in also investing in the pipe, like Chamat has done that. There was a deal that got announced yesterday. Again, sponsors came in and invested in the pipe as well, which helps the markets build more conviction about the offering to show that these investors are putting a lot more money than they would otherwise. Yep. I like the company so much. I come in the double down X, Y, and Z as a SPAC sponsor. I come in and I also put in my money in the pipe because I believe in the future of this company. Could be a great indication for the capital markets.
Very nice. I think it's so good to talk to you about SPACs because you know a lot, you're passionate about it, and you're experiencing it firsthand with your portfolio. I want to go to something very light before we go into the end on something more inspiring. This is very tactical, and many CVCs don't even have a full-time marketing principal like we just have now. But
Congrats.
You're posting on Medium. most corporate VCs post on their own website or on LinkedIn. Can you talk us through why Medium and why do you think more and more VCs do that?
I think it's important for a few reasons. Number one is whatever you do, whatever rationale you're coming up with, it's important for everybody in the ecosystem and the information to be more transparent so that people understand what the main argument here is. Number two, that also helps you keep yourself accountable down the road. What did I do back in the day? Why did I make that investment? What was my rationale and how it turned out to be? And number three, it is also partially marketing. It also helps you let the market know that you made those investments, and companies that are in adjacent spaces would see your posts and hopefully your learnings. Again, this applies for your fellow investors who could see the way you think and also build their own thesis. And also helps you source more deals. I got so many leads from my posts, to be frank. They just email me out of cold. As long as I get cold emails from the founders, I always respond back because I don't think that you need to have certain a well-established network in Silicon Valley to get financing. It's exactly against what I stand for. So,
actually, I love what you just said, which is when you get cold emails from entrepreneurs, you respond. And I checked on your LinkedIn, and maybe the audience should know that your email is right there in front, and you say you will respond. So I think that's really telling a lot about you. And clearly.
Yeah, and frankly, Nicolas, I think I prefer well thought out cold emails than some weird, potentially warm intros, to be frank, because that shows that that person has done the work to go through what you are doing, what you are investing in, why what they are building could be relevant for you.
Yep. No, I think you're making it easy for any quality entrepreneurs to reach out directly to you and for them to know what you care about because of all the Medium posts and so on. That makes a lot of sense. In a way, you're trying to make sure that the entrepreneurs that matter to you knows how to reach out to you.
Absolutely, yeah.
Very, very good. And so would you say it's a best practice that every time you make an investment, you're going to post on Medium to say why you invested, what was your thesis, or do you do it selectively?
Especially if you're leading around, I think it's important for people to understand why you're making that investment. Let's say if you're putting in a small check, you may or may not necessarily have enough of time or dedication to build something, especially if you're on board of the company. But if you are taking the lead role and building that conviction, making that big bet, leading that whatever 15, 20, 30, 40, $50 million round, it is important to express the thought process and the logic behind, at least at the very high level. Obviously, you're not going to share any confidential information, but it is important to have a bit more transparency, as so much has been happening in Silicon Valley behind those secret doors. So I think we should all aim for making this a level playing field for anybody out there, because there's so much of this pattern recognition argument that justifies to invest in certain kind of entrepreneurs, which is probably the most controversial thing I'm against. I don't think there's one single pattern that fits. Okay, this is the ideal founder. I looked at it. He looked like X, Y, or Z, or she looked like X, Y, or Z. I think it's important for all of us to keep an open mind, look at every single opportunity based on its own merits and data.
So what I love about what you said is you haven't used a word, but everything you say will help to get more diverse entrepreneurs to get funded. So this is really, really good.
Yeah, and that's why I think it's important for the founders to reach out every relevant person that they believe. They should not feel like, okay, I don't know X, Y, or Z, how I can get a hold of that person. If you think that's the right fit, go out. And obviously diversity is a topic dear to my heart. There's no question around that. So.
Very nice. So I want to keep the last 2 minutes for you to maybe talk to the entrepreneurs who are listening to us. What are you most excited to invest next?
This goes back to what I was saying. It is all around, if you're building a cutting edge technology-based solution in an archaic and large old school market where you're changing the economics of the business, that is specifically what I get excited about. Obviously, it could be mobility, it could be manufacturing, could be a bunch of different other topics. Especially you get to see all of the investments I have made. Probably entrepreneurs are going to have a good sense of what are the success stories we've got so far. as you've alluded, as Zal mentioned, my first deal ever led the Series B round. We were one of the largest shareholders, just filed their S1 going public. So I hope that there's enough of information out there showing the people what we get excited about, what we are working on, but always happy to take another look on the topics that may not be necessarily as relevant yet, given our scope of the mandate, meaning that we cannot make investment in dating apps, we cannot make investments in genetics apps. We're also getting those kind of leads, but obviously, that shows that maybe that person has not looked at our investment thesis or profile. That makes it tougher for us to then answer them, right? That shows that maybe they haven't gone through that. But if it's about mobility, if it's about manufacturing, if it's about enterprise software, which could touch automotive one way or another, or if it's about sustainability, we would love to get in touch.
Baris, it was exceptional talking to you today. I think you're sharing so many golden nuggets and best practices that I think so many of us should emulate. So thank you. Thank you very much.
Thank you very much. Pleasure is mine, Nicolas.
Have a good day. Bye.
You too. Bye-bye.